we have a broker who's telling us, trade outs are 10%, 20%. Like, look at this, there's all the growth here. But when we put it in our model, we don't actually observe something like that where the
Right.
rents stay constant or, growth isn't anywhere near what they have been quoting us.
I'm Drew Breneman, and this is the Rise and Invest podcast. I bought my first 2 properties as a 19-year-old with my own money that I earned from an online business I started in high school. I've now grown my portfolio from that first duplex to hundreds of millions of dollars of investment property. My goal with this show is to give you the resource I wanted when I first started out. Subscribe to our podcast where I break down real-life stories, tactics, strategies, and current market information you need to be a successful investor. Welcome back to another episode of the Rise and Invest podcast. Today's episode, we're going to jump into underwriting and different tools that we're using. I've had a lot of people ask me about what I've done for underwriting over the years, and especially, today and actual tools we're using to underwrite and analyze live deals. So that's what we're going to jump into today. With me is Evan Dillon. Welcome.
Thanks for having me, Drew. It's good to be back on.
Yep. So Evan's vice president at our firm, and he's really done a ton for us for improving our models and underwriting and everything. So I want to have him on here to chime in as we go.
Yeah, and it's good to join again. And do have quite a bit of modeling experience. From the get-go, getting involved in real estate, it was always something that I was very, very interested in, and something that I always wanted to do, just learn more and get better at it. Even through school, I took coding classes and statistic courses to see how could things like predictive analytics come into play, or just coding classes where I can automate things. And then, also pairing that with significant experience underwriting deals. So, before I was at Rise Invest, I worked at an institutional private equity real estate shop, and, I was there for 4 years. Close on like $2.5 billion worth of deals. So it's a lot of underwriting, and, maybe you hit on 10% of the deals that you do actually underwrite. So, it's a lot of deals to get through. And, I learned, a lot of the tricks to the trade in terms of improving analytical infrastructure to, make better predictions, and then just, automate things to a point where we're continuously condensing down the time it takes to underwrite a deal, so we can spend more time on, the important things like decision making, and then the human input that goes into these models. But yeah.
And it's something that you're passionate about, comes naturally to you. I know we shot an episode earlier about your NCAA bracket optimization model. So if you haven't checked that out, go back, take a listen to watch that episode. So it's never heard of anything like it. So and so in my background in terms of underwriting is different, I guess, where I started out underwriting deals. This is when I was a teenager, that I was going to buy, 2 to 4 units. And, I started out there was actually Robert Kiyosaki. He had on some website, like a real estate cash flow calculator. Basically it makes a pro forma, but you just type in the rents and then the expenses, and then it calculates it for you, tells you what your cash on cash return would be.
Mm-hmm.
So I started out using that to get kind of going and see how cash flow positive these deals would be, what the returns would be. And then after using that online calculator, just calculating and basically writing the numbers down on paper, what are the rents and expenses, and figure out what my loan amortization would be, and just calculating it on a yellow legal pad, and that
not stone and chisel.
Right. Because when you were at that age making this bracket optimization model in Excel, or getting version 1 of that kind. So no, these were like 2 to 4 unit deals, and really they were, at that time, so it's my own money too. So I'm not solving to like what's the net LP return, on a 3-year hold. Like I'm trying to think, is this the cash flow and the amount of loan principal that I'm going to pay down every year, is that a sufficient return for me?
Mm-hmm.
And then that was one. And then the other thing that I realized real early on was you need to figure out how the market is valuing the property. Because I have heard people say, individual buyers. How I underwrite the deal is I want a X% cash on cash return. That's our only metric.
Mm-hmm.
Well, but if you manage the property on your own and you have really low expenses, you could overpay for that property.
Yep.
So I figured that out, early on, and then wanted to have that dialed in. I was buying a unit in Madison, Wisconsin, and it's like a 10 gross rent multiplier market. If it was a building where it wasn't on a boiler or just on one heating system that the landlord paid, if it was on that, then the gross rent multiplier would be lower. But I'd make sure I'm going in at a number that makes sense. If the market's at a 10, obviously you want to go in lower than that if you can, or buy a deal where you look at it and go, wow, once I move the rents up to where I think it would, I'll be way below a 10. So it's
Mm-hmm.
not that different than what we were kind of doing now, except it wasn't using cap rate yet, because that wasn't what people traded those deals on.
Mm-hmm.
So there was too much expense variation, and it's only a 2 to 4 unit. A lot of people are just valuing those just on their phone, basically, like, what are the rents times 12 times 10, okay, here's what
Yeah.
it's worth, and then after a while you figure out you can multiply by 120. Skip the step. I'm just kidding. But anyway, I started out with that, and then obviously as the deals got bigger, for me, I would make just a basic pro forma and then run it out, for 10 years, but nothing too crazy. And then on those refinance deals that we did, where we refied out all the money that I've told you about a bunch, we just looked at those actually, and we would not even figure out what's the IRR on them. That wasn't our goal. What's our IRR? So what's the what's the return going to be over a certain number of years? We were just thinking, okay, we buy it now, and then once we get the rents to where we think they should be and the income, how much money can we refinance out? So we're actually just making like 3 or 4 pro formas was my underwriting.
Mm-hmm.
Today, what's today's situation? What's it worth today? Because I also still had that eye on the value, obviously. And then how much can I refi out? And I mean, I remember passing on deals where the returns would have been, I bet, really high, but in year 2, I could only refi out like half my money.
Mm-hmm.
If you're just trying to turn over your own money, or you have a limited amount from another person, like if you do that deal, you only can refi half your money out. Now you're stuck. You can't get the next deal. So then I was pulling the trigger on deals where you look at me like, wow, if this and this happened, we could refi out 120%.
Mm-hmm.
And then we do that deal. So yeah, that's kind of how things have gone for me over the years. And then obviously now that the whole we're not doing a lot of deals where we just buy and try to refi out all the money right away. So now we're using a more comprehensive model that we thought was good, and then when you started, we implemented a way better one even. So
Yeah.
so that's kind of my story there on how things have gone for me underwriting. So just want to start with that, because I guess we're probably getting to a lot of stuff we're doing today. But if you're buying like a duplex or something, this is just kind of an episode you probably want to pull bits and pieces out. Things we'll get into, but you don't necessarily need a lot of these features or things we'll talk about, and more just like the concepts are important, where more so than just spending, because you don't want to, I guess on these smaller deals, you don't need to overthink it either. It's
Mm-hmm.
kind of simple, like I was saying, people valuing on their phone, like that's who you're up against.
Yeah.
So
And I think it's really interesting, you know, go from different size of building, different product, different market. Uh, the investors that you talk to, or we talk to, it seems like there's always a different metric that they really like. Where, I want to have a year 3 stabilized cash on cash of X%, or I'm a stabilized cap rate buyer and I want to hit a 5 stabilized cap rate if I were to just snap my fingers and bring the markets to market, or do my renovation and everything's done today. Or some people are an unleveraged IRR buyer, which is just to say the IRR that you would achieve should you not put any debt on the property. Some people look to leverage IRR, net to the LP IRR. So I mean, there's different, a long list of metrics that people look to in examining, the financial wherewithal for a potential investment. And it's good that we have a model that takes all of those things into account, because when we do talk to investors, we can pinpoint to this, that, or the other and say why or not this might be a good fit for the investor.
Right. You just want to jump into that then? Maybe let's talk about how our model works, the one we're using today.
Yeah.
Just kind of take it from there.
Yeah. And I think, in underwriting a significant mass of deals, I think, one of the things that people really need to take into account, especially, with our operation where, we're heavily involved in Phoenix and we, still do have like a little bit of pulse on the Chicago market. Um, you underwrite a lot of deals, and to uh, feel like you're getting a risk adjusted return. That's a term that everyone likes to throw out. Risk adjusted, just meaning I'm getting an outsized return for the amount of risk that I'm inheriting with this property or this project or this particular strategy. Um, you need to underwrite a lot of deals to understand what's a good deal and what's a bad deal. What constitutes something that's something that's worth pursuing, really.
Right.
So I mean, in thinking about that, the key is really to automate as much as you can. And I think about something all the time, whereas I should be thinking about how long does it take me to underwrite a deal. Maybe it's 2 hours. Well, I should be actively thinking of things that I can do to condense that time period, um, you know, so that it lessens, for the future. So can I get, you know, 2 hours of underwriting down to 1 hour? And then from 1 hour, can I get it down to 30 to 40 minutes? Um, so, when thinking about that and setting up our analytical infrastructure, it's a little bit of like a delayed gratification where, we put the work up front to make sure that we have the analytical firepower to not be spending 2-3 hours at a time underwriting a deal. We need to have the infrastructure in place to just populate the model and go. And that leaves us, more time to think about like the human input that's needed for a model where, we observe there's rents occurring at this other property that we think is a comp. So we need to identify that. There's more time spent on decision making because we can rely on the existing model for accuracy, and just consistency
Yeah.
overall.
Yeah. And one thing to jump in on that would be interesting where over the years, a lot of people have asked me about like, how did you have the confidence to do X or Y or whatever, or even to buy the first deal? That wasn't just the first building I walked into.
Yeah.
It was exactly to your point. And again, it was more of just a gross rent multiplier, apples to apples thing. But when you looked at a lot of deals and you go, okay, I see this. Normally things trade for like a 10 GRM. Then you see someone pay a 12 and you go, wow, they really paid a lot. Then you just kind of keep watching. And then something comes through where it's below a 10, or it's a 10, but the rents are really low. And then you look, wow, in a year I could be at a high 8.
Mm-hmm.
You can be confident then.
Yeah.
You've looked at all these and you go, this makes a lot of sense. Also, when you do that, there's a big spread. You could make mistakes then if you think, oh, I'll stabilize in the second year and I'll be at an 8 something GRM. Market's a 10, and some people that are, for whatever reason, paying a 12 on some deals, I'll be in a great spot. So then you can be confident. I mean, that's something too that jumped out as that came to mind when you're saying what you're saying. Because then, why would we have the confidence to buy a certain deal? Maybe we underwrote 20 of those, and this one has the highest, pick a metric, highest stabilized cap rate, highest, IRR, and then it makes a lot of sense to move on that.
Mm-hmm.
You don't need to spend time like overthinking it.
Yeah. And, you're not devoting time to tedious tasks that you have to do over and over again, like cleaning up a rent roll or cleaning up a T12 or, assigning a particular renovation or business plan to the property and having to go, unit by unit, understanding, the current finishes and things like that. We have a model that's built to streamline much of that process for us so that we're not dedicating our time to, mundane tasks that, would normally take a few hours. If we were just to do it by itself, we have the infrastructure so that it does it automatically, it does it seamlessly. We can spend more time on decision making, human input, and we can be in, rest assured
Yeah.
that there's more accuracy, there's more consistency. Um, and I mean, just to elaborate on that point, one of the things that our model does is that it does have that advanced, data integration capability. So, I talked about like cleaning up a rent roll, cleaning up a T12. We utilize a service called Red IQ,
Actually, let's
which,
just back up. So if someone's new to this, they're not going to maybe know what cleaning up means even. So what's like a common thing people are spending a lot of time on with cleaning up? What does that like exactly mean?
yeah. So, when you receive a listing or you're underwriting a property, it's pretty much the standard deliverables that you'll get to, inform your decision and just build a model. You're going to get two things basically, which is a rent roll, which is a schedule of all the rents that are in place by tenant, by floor plan, and what's their lease start date, what's their lease expiration date, when did they move in, what are their other charges, and then there's a T12, which is trailing 12 months of financials.
An income statement.
Yeah, an income statement. And a lot of the time when you get these types of files, the data just comes in a very unorganized fashion where it's not readily usable. So a rent roll, for example, you might have rent charges listed downward and by unit, but the order in which those rent charges appear aren't consistent, or there's not the same amount. So let's say I'm paying my gross rent, I receive some type of concession, I have a pet, so I pay pet rent, I have pay for valet trash or something like that. So there can be all these different charge codes that I can't easily manipulate the data that exists in the rent roll.
Right. It can also get sent as a PDF instead of in Excel.
Yes.
So now we're just looking at, because the old way is you're just looking at the numbers and go, geez, I got all these different floor plans and charges, and I have this PDF. I need to now somehow get it into Excel.
Mm-hmm. Yeah. And then same thing with a trailing 12 financial statement. You might get an Excel file that's 100, 200 rows long where everything's from replacing the blinds on the windows to replacing locks to just your office expense and what it takes to market the property. It's all very scattered. It's usually not in like comes in a version where like those expenses are condensed in something that we can just call like an umbrella expense, like repairs and maintenance. What does it cost to market the property and list these units online? What does it cost to assume that there's one or two people who work at the property are on the payroll and work on site. So that's something that we do for the T12 is where we want to clean up the data so that we can organize it and standardize it in a fashion where it can flow freely through the model.
Right. And two, even if we got sent a very nicely organized set of trailing financials, it might be organized differently than your model setup, or you're used to having the same expense categories in your model, and then they have things in different categories. One thing on just a random example on like a Freddie Mac loan, they have their trash, they move it to repairs and maintenance, where other people have that as a utility.
Yep.
Some people it's a contract. Like, what is it? So it's these things where and it's, as long as it's accounted for, I don't know who's to say what the right category is even, but it's, you want to be able to compare apples to apples. So then when you get a deal that owner has the trash in contract services, and you go, oh wow, what's the contract so high? Well, maybe you were just looking at a deal where it was in utilities or in repairs. That's why. And then this way is this Red IQ service is a way that it can scan the PDF or file, and you can rather quickly organize it and then get it the way you want.
Yeah.
It eventually learns what you're picking to speed it up.
Yeah. And, Yeah, so it's a great service where you can just upload the rent roll file, upload the T12 file, and it'll clean it for you. The thing though is that just having that by itself isn't necessarily enough because I can export that file into Excel file, and then it's readily available, it's standardized, but most of the time, that data might exist elsewhere. Maybe it's not included in the model, or if I do integrate it into a model, I'm spending time, linking cells to reference what the repairs and maintenance line item was, or I'm linking these cells to reference directly to the rent roll. Whereas, the way that our model is set up as of right now is it has that data integration where we export those files from RedIQ, and then there's almost like a data import um, where in our underwriting model, we can just copy and paste those specific files into our model, and then everything flows freely and automatically. You don't have to link any cells. You don't have to do any of this other, mundane tasks or tedious tasks where I have to make sure that the information is presented properly. Everything just comes into the model and it's good to go.
Download our 100+ page passive investing guidebook today at riseinvest.com/downloads. Accredited investors can sign up for our multifamily investment opportunities by hitting the Invest Now button on our website. Now back to the show. In terms of specifically, and actually before I get into that, Red IQ, something like this would make sense where if you're buying buildings that I would say are consistently maybe over 30 units, or you're getting into 100-unit buildings, it might be overkill if your biggest deal is going to be a 20 unit,
Mm-hmm.
because it's not free to have the service, and then you need to have your model set up that way. Because I'd say, a lot of the earlier deals I did in Chicago, they were 5 to 8 units, and
Yep.
there's no, you can do the same thing Red IQ is doing just in that size building, just with your eyes, and line it up and move it pretty fast. It wasn't, you never get sent anything that's 200 lines or whatever it would be on some of these bigger deals.
Yeah.
So then that, just to point that out, but once you get into these larger deals, you could spend what would feel like a whole day cleaning up a rent roll in a T12 if it's, a 200-unit building, and they're using all these different categories and have all this other income to account for, and utility bill backs and all these things that then you could spend, half your day just getting that in a usable format.
Yep.
So that, and that, just to point that out. And then two, I think, kind of where it would be interesting to hear, like, so in our model, the information comes in from Red IQ, but how does it actually come into the model? And then how is it looking up that?
Yeah. So the way it works is that we import that rent roll or T12 file. It's always going to be a standard way of importing it, where I'll name that specific tab of the Excel rent roll or whatever. And there is another tab that is just directly linking to, it's looking for a tab named rent roll, and it'll only link to a tab named rent roll. And if there's no tab that exists in the model, it'll just be zeros or NAs or errors or whatever it is. But once that tab is integrated into our model, it sends the data to just this one other tab that just references everything from that tab that's named rent roll or T12.
Right.
But from there, we have, a way of now all that rent roll data is in our model. It exists. We didn't spend any other time like cleaning it up or linking cells or anything. Automatically, it'll bifurcate each unit by floor plan, where we can visualize the average rent of leases signed by any given month, by any given floor plan, by any given renovation status. So, a lot of people might be, spending time on like trying to think of like what unit is what, or, not have something where I can actually see the trends that exist from, let's say, a particular unit where, we have an average rent that was signed for any given month. there's no way of
Yeah.
visualizing that. So that's something that's built into our model. So, you know, and that's particularly, that's the reason why we were drawn to Phoenix, where, um, all these other markets that we were looking into, we would have that same feature where we could see the average rent that was signed by floor plan by month. And, we have a broker who's telling us, trade outs are 10%, 20%. Like, look at this, there's all this growth here. But when we put it in our model, we don't actually observe something like that where the
Right.
rents stay constant, or growth isn't anywhere near what they have been quoting us. So that's great for identifying trends. And then the flip side of that is that let's say it's a value add type deal where we're doing cosmetic renovations for our property. It's the same deal where we can bifurcate, unit type by unit type by renovation plan, or sorry, renovation status, and we can assign a particular renovation plan by each unit and assign a premium for that particular unit. Whereas, other models might just suggest that let's just use a total weighted average. I'm going to assume 15,000 to spend per unit. I'm going to get on average a rent premium of $200. But the thing with that is, when you look into the market and dig into like what a renovated studio unit with a washer dryer would go for, a renovated one bed with a washer dryer, uh, you know, having that bifurcated data, it leads to our projections being much more refined, much more granular, so we can like actually project the rent by you know given
Right.
unit type.
We're actually calculating how many units would be renovated and what the rent would be, instead of doing, well, okay, this percent
Hmm.
is done times this, weighted average rental amount, and then
Yeah,
that's our total. Where we're just, that's almost like an estimate if
yeah.
you're underwriting like that. And just to kind of paint a picture on the rent tab that Evan's talking about, it's, just imagine all the unit types. If it's a big building, there might be different types of one beds, different floor plans, or renovation status. That means how far, like how nice, how much they've been renovated. So you could walk into a deal where all the one beds, let's say, are renovated, but maybe 10 aren't renovated at all. So then you have 10 that are just, they'll call it classic, so just the original finish. 10 that are renovated, and then maybe out of those 10, like 5 have in unit laundry, 5 don't. So
Mhm.
then you can make those 3 different types of one beds, with a renovated, unrenovated, and then a renovated with laundry. And then you can visualize, kind of going from left to right, chronologically, what leases have been signed on those different unit types, because you
Mhm.
can code all this as it comes in the model. And then and then you see the trend, or what's the most recent lease signed, or um, just all the leases that were signed in the last 12 months on by unit type. So that's, yeah, to Evan's point. And then on a trade out, that's just the rental increase on a new lease for compared to the old lease. So then, right, we're told these things, where these trade outs are way up. Then you look at it actually mapped out, and you you like laugh to yourself, because it's like, no, they just picked that one unit with this
Mhm.
huge trade out, but that's because the unit was just under rented before.
Yeah.
So we're gonna publicize that. But then that's interesting, on the two beds, you didn't get any 10% trade outs.
Yeah.
Yeah. So then that, but when you look at some of these markets, though, especially, and we talk a lot about Phoenix, and it's happened in other places, but there you see trade outs, and it's, 20% plus, or every unit in every building, it feels like, is up.
Yep.
It's on the whole thing, where the trend is so obvious. And in a lot of markets, you underwrite a deal in like a normal place, and it's the trend is up, but it's not like as pronounced, where it's literally every unit every month, as far as this goes back.
Correct.
Yeah.
Yeah.
So then that's been useful. And then when how does that information actually flow through the model then? Because I know, I mean, I guess, and also too, as a housekeeping thing, I know how this works. I'm just asking the questions to, like, have the
We have
conversation.
no
But
clue what's going on.
yeah, so yeah, I've always wondered how it works. So, no. So obviously I know how it works, and but it's, and I guess I haven't even really learned how to ask a question where it's not like as if I don't know. I
Yeah.
mean, it's a skill I need to pick up, but
Yeah. So the way the rent roll comes through is it's organized in a way that's standardized for every single model. So when we have 10 tabs like such as the rent analysis tab, um, it's just cleaned up and ready to go, and the information flows freely through it. Um, but it uses a variety of VLOOKUPs, HLOOKUPs, where that's just an Excel function where basically I'm looking for an array, and for X value I want it to look up this value.
Yeah.
So when doing that, it's a combination of those functions where I can go back and say I want to do a VLOOKUP for this unit type in particular, and then in addition to that I want to do another VLOOKUP or HLOOKUP for all the leases that were signed in this given month. And so I can narrow down the data to find how many leases were signed for that floor plan in any given month, and what was the average rent that was signed by that unit type for any given month. So that's how it
Right.
works. I wouldn't say it's rocket science, but it's something that's extremely valuable.
Yeah, and if you haven't used Excel a ton, I mean, or if you got lost there by the time we got to the word array, it's basically just look. It tells where to look. It says, okay, this is the unit name we're looking for, and then when the lease is signed, pull the value through.
Hmm.
That's why. So we're not manually finding things or linking things together, because it knows, okay, when you see this word or unit type appear, then give me all the values and that are that pop out for rent. So
Hmm.
it's not. That's why when we talk about flowing through the model, the whole thing's set up where it just looks up values at different stages and the information populates.
Yep.
So that's what we're talking about on that. Well, nice. Well, then what? You just want to keep taking us through the model, or talk more about underwriting, or what do you think?
Yeah, and I mean, there's different functions that just make help make the model more accurate. You know, namely, that same rent roll data, it flows through what we'll call like a turnover analysis tab, where essentially, it functions similarly to the average rent that was signed by floor plan by month, where we in this turnover analysis tab we can actually identify how many trade outs we expect to occur in any given month, what's the average rent of those in place leases that were signed and are rolling over, what's the market rent for those leases that are expiring, and then what rent do we want to ultimately like renew at.
Right.
And then we can also layer in the premiums that we achieve during like a renovation program, or assign increases to just the in-place rents. So just say, you know I'm turning over these 8 units, 4 I'm going to assume just renew, and I'm just going to increase their whatever they had by 5% or whatever number. But the information, it flows
Yeah.
through it like that as well.
Well, great. I think we covered plenty on the rent analysis tab. So let's just maybe run through quickly what happens from there in our model.
Yeah, so all the information from which helps us to help set our rents, it flows through a pro forma, an 11-year pro forma, which is basically a schedule of your rents, your other income items, and your expenses, and all of that amounts to what we'll call net operating income, or just your total income minus your operating expenses. So we can plot that out year by year for 11 years. And following that, that'll flow through a return summary page whereby we can input, the exact value for which we're acquiring the property, and then assume I'm going to hold this thing for 3, 5, 10 years, whatever it might be. And then I can project, a series of different returns, whether it's an IRR, an equity multiple, leveraged IRR. So I'm assuming debt, a leverage equity multiple, stabilized cap rate. So that helps us, it gives us metrics to follow and determine like what's a good investment.
Something that I think is important to think about then, and this I think should be in potentially any model at a certain point, is buildings. Because once you do this a lot, you'll see you almost have the pro formas depending on who's using it. They'll be different on the same building. Like a lender would make a pro forma on the building, and let's say in a market where the vacancy rate is 3%, buyers are going to assume usually 3% vacancy, but a lender is going to assume usually on apartment building a minimum of 5. If the market's higher than 5% vacancy, they'll assume more. So then one thing that I built in my earlier models was just different ways to look at the deal. Maybe you have a pro forma that would be just for cash flow. That's the full expenses, and we'll say like if the market is 3% vacancy, then it's got your 3% vacancy in it, and that would be a good pro forma to use and then run out over time, like you were talking about in a 10 or 11 year pro forma, and see what's my cash flow going to be. But something I think people really need to be aware of as they keep doing more deals or bigger deals, or you start refining your underwriting, the lender is not going to use that cash flow pro forma. They're going to make their adjustments. And if you can figure out what adjustments they make, then you should make a pro forma that would then solve to a lender, let's call it net operating income, which is the bottom number on the pro forma. And then you can back into what loan you could get approved for. So like in our model, a feature that we added was where we're doing just that. We're saying, here are the adjustments the lender makes. And then now we can solve using a bunch of different, limiting constraints, a debt service coverage ratio, loan to value, debt yield, all these things that then help us go, okay, when we talk to a lender, now it's a different conversation. We're not saying it's a 22 IRR. We're saying, hey, it's a 7 debt yield in year 3.
Yeah.
And they're getting excited. So, that's something that as you do more, you'll see that. And then also when you might use a different pro forma for value in it. Like let's say you're modeling your deal out, but then you're in a market where the property taxes change upon sale. Maybe you're going to need a way to maybe adjust for that, because you're going to run your pro forma out and go, okay, great, I'll sell it at whatever cap rate at the end. But that's not the pro forma the buyers are going to use anymore, because they're going to say, I need to up the taxes when I buy, because now they're going to adjust to the sale price or whatever they do in your market. So that's something where that I've found extremely helpful, because again, if you're going to just use one pro forma, maybe if it's your cash flow one, you're going to sell it for too much or not enough, depending on what the assumptions are. And then you send that, the one you estimate your cash flow with to the lender, and they're going to go, oh, look at this. The guy has the too low property taxes in here, because they're using the real property tax number, where a lot of times a lender, they'll have like a minimum number that they will size to, like on a agency loan, I think they're limited to an appraiser estimate, or the actual whatever is higher is what they'll use. So, where then you need to know that, where then, okay, I'm buying this deal, they're going to move my taxes up potentially, and then on their pro forma, and then use a higher vacancy. So that's stuff that, I've figured out over the years we've added to our model, but you could even incorporate that just on a more basic level. Like you're buying a 2 unit. This is basically what I was doing. I was going, my valuation pro forma is my 10 GRM. And then, the reason I stopped talking, it's funny, I said we calculate that on our phone. This was before you had a calculator on your phone. That's funny. I just realized that. So you would have to do it on your calculator. And then, and then your cash flow on that would be like the thing I was using the online calculator for, actually doing the math on the paper. And I'm still more or less doing a higher powered version of that, today, or we are.
Yeah.
So that's something too that I think would make sense to add into a model or consider when underwriting. I think too, one thing, and this applies whether you're dealing with a large deal, small deal, how advanced you are, is I think on a lot of these line items, like payroll or utilities, don't be afraid to make an actual budget, because if you know what you're doing in time, you kind of fall into these like per unit kind of guidelines or things that people typically do or you see. But then, it's really important to check that against what reality might be.
Yeah.
Like if you just use a certain payroll per unit number, when was the last time you actually made a budget showing all the payroll costs and like check that?
Yeah.
And if you're brand new, well, that's how you could get your payroll number anyways. And if you're not brand new and you're using that, it's a lot, maybe your investor is going to go, how'd you come up with that number? And it might not be smart to go, well, I don't know, everyone uses, $1,400 a unit in that area. if you can give them a budget, they'll go, okay, well, that's a well-supported number. There's
Yeah.
no more questions.
Yeah, and our model it accounts for that, where we can get as granular as we like, and we can have these an umbrella expenses that encompass everything that might be related to it. Let's say payroll, where I want to account for the salaries of my employees, the benefits, the bonuses, payroll tax, insurance, things like that, so I can get more granular and list those actual expenses. And I think a lot of the time when someone is just trying to understand the market for the first time, they would like to just take the rent roll, or sorry, the T12 for what it's worth. So, you might see $2,000 per unit spent on payroll for, let's say, 100-unit building. And you start to dig into that and see that, okay, maybe there's this family that's been operating the building. They're not a, fully integrated property management company that has 10,000 units under management and they run it efficiently. Maybe they run the property the way they want to. They have 4 people on the payroll when there should only be 2 people. So that's something to really account for when you're trying to understand a market, where don't just take what the T12 is telling you. You really need to understand the nuances to these expenses and get granular, just as you suggest.
Well, and oftentimes the your example was a T12 with a high number. Usually, more often you'll see a trailing financials where the numbers are low, compared to what's actually going on. And that's one, advantage. Once you actually get active in a market, what the costs really are, because you have real buildings you own and can look at. Where when you're just kind of starting out looking at a place, a lot of times people sell the trailing financials. They're, things, if anything was like a one-time expense, let's say they repaint the hallways every year. Well, when you're selling, a lot of people go, oh yeah, you don't really do that every year. Let's move that below the NOI. Like it's like a CapEx kind of thing. We don't need to include, but then usually you're, you're making adjustments up, I feel like, is kind of what is like a rule of thumb, where it's not, typical where you're going to see something where you go, okay, we'll be able to cut this. That's a nice opportunity where you'll see that sometimes, but it's usually more the other way, where you're getting sent a financial that's, kind of thinned out, and you need to be comparing that against other deals you saw, other deals you own, what people were saying in the market. Cool. So I think that's probably plenty on our model then, on how that works.
Thanks for joining us on the Rise and Invest podcast. Please be sure to hit that subscribe button on YouTube or wherever you enjoy your podcasts. If you'd like to dive even deeper into real estate investing, check out our company's website, riseinvest.com, where we have numerous free resources and information that can help both active and passive real estate investors. Our 100-plus page passive investing guidebook, our trends report, and our blog are all available on our website. If you are an accredited investor, you can get started today as a passive investor in our multifamily investment opportunities by hitting the Invest Now button on our website.
The views and opinions expressed in this podcast are those of Drew Breneman and guests as of the date of recording, and do not purport to reflect the views or opinions of Rise Invest Holdings LLC and its subsidiaries. The views and opinions are provided for informational purposes only and should not be relied upon or deemed as investment or tax advice or an offer to buy or sell securities, and the speaker cannot be held responsible for any direct or incidental loss incurred by applying any of the information offered.